Welcome to episode 9 of Nova Bourse, where we tackle the income statement and the vital concept of margins. Throughout this season on fundamental analysis, we are building your toolkit for evaluating businesses from the ground up. Today, we confront a classic investment puzzle: why two companies generating identical revenue can produce radically different levels of profit. By the end of this session, you will understand what that divergence reveals about the true underlying economics of a business. We are moving beyond the surface-level numbers to uncover the efficiency and competitive strength hiding inside the financial statements of major U.S. corporations. Let's dive in. In the world of investing, there is a golden rule. Revenue is vanity, but margin is sanity. Consider two scenarios. A company generating $100 billion in sales with a 2% net margin keeps only $2 billion. Conversely, a company doing $20 billion in sales with a 25% net margin keeps $5 billion. That second firm earns more profit from just 1/5 of the revenue. Margins are the ultimate lens for comparison because they strip away the distorting effect of sheer size, revealing pricing power, cost discipline, and business model quality. Today, we dissect gross, operating, and net margins, showing you how to use them with real data from the U.S. markets. To see this in action, look at Walmart versus Nvidia. In the fiscal year 2025, Walmart generated roughly $675 billion in revenue. In contrast, Nvidia generated about $113 billion in trailing 12-month revenue through late 2024. That is roughly 1/6 of Walmart's top line. Yet Nvidia's net income exceeded $70 billion, while Walmart's was approximately $20 billion. Nvidia made 3.5 times more profit from a fraction of the sales. This happens because Walmart's model relies on volume and velocity, while Nvidia's thrives on scarcity and pricing power. This comparison proves why you must master the income statement before judging any company by its revenue alone. The income statement follows a strict, logical sequence. At the top, we have revenue, or total sales. Subtract the cost of revenue, also known as cost of goods sold, and you arrive at gross profit. From there, we subtract operating expenses like research and development, sales and marketing, and general and administrative costs to reach operating income. Finally, we subtract interest expenses, adjust for interest income and other gains or losses, and account for the tax provision to reach net income, the bottom line. Each of these subtraction steps gives us a specific margin: gross, operating, and net. Each tells a unique story about the business, which we will explore using real-world examples. Let's start with the first filter, gross margin. This is calculated as gross profit divided by revenue, and it measures what a company retains after paying the direct costs of producing its goods or services. A high gross margin often signals strong pricing power or a capital-light business model. Conversely, a low gross margin might indicate intense commodity competition or heavy physical infrastructure requirements. Gross margins vary drastically by sector. For instance, software companies often see margins exceeding 70%, while grocery retailers typically sit below 30%. Because of this, it is misleading to compare gross margins across different industries, but comparing them within the same industry is where the real investment insight lives. Looking at a specific example, Nvidia reported revenue of $35.1 billion in the third quarter of fiscal year 2025, with a GAAP gross margin of 74.6%. This means for every dollar of chips sold, they kept roughly 75 cents after manufacturing costs. Their cost of revenue was only $8.9 billion. This figure is extraordinary and reflects their near-monopoly power in the artificial intelligence accelerator market. When tech giants like Microsoft, Google, Amazon, and Meta are all competing to buy your hardware, you simply do not need to offer discounts. Even on a non-GAAP basis, excluding certain stock-based compensation, their margin was even higher at 75%. Now, let's look at the opposite extreme, Walmart. In the fiscal year ending in January 2025, they brought in $674.5 billion in revenue. However, their cost of sales was $511.8 billion, leaving a gross profit of $162.8 billion, or a gross margin of 24.1%. This is not a sign of weakness. It is the deliberate, high-turnover strategy of retail. They make money on volume, selling inventory quickly at thin margins. To analyze this correctly, you should compare Walmart to peers like Target at 27.9% or Costco at roughly 12.8%, rather than comparing them to a chipmaker. Next is the operating margin, calculated as operating income divided by revenue. This takes our gross profit and subtracts all operating expenses, including research and development, sales and marketing, and administrative costs. This is often the purest test of a company's core business quality because it shows how profitable the operations are before we account for interest, taxes, or one-off items. Operating margin strips away distortions like debt levels or specific tax jurisdictions. Two companies might have identical gross margins, but if one spends significantly more on innovation or advertising, their operating margins will look very different. This metric truly separates the efficient operators from those with bloated overhead. Consider Microsoft's fiscal year 2025 results. They delivered $281.7 billion in revenue and a gross profit of $193.9 billion, resulting in a gross margin of 68.8%. After subtracting $65.4 billion in operating expenses, which included $32.5 billion in research and development, they arrived at an operating margin of 45.6%. This demonstrates massive operating leverage. Even while investing heavily in artificial intelligence and the Activision Blizzard acquisition, Microsoft converted nearly 46 cents of every revenue dollar into operating profit, proving that their revenue growth significantly outpaced their spending growth. When we compare Coca-Cola and PepsiCo, we see how different business models create different operating margins. In fiscal year 2024, Coca-Cola reported a GAAP operating margin of 21.2%, reaching 30% on a comparable basis. PepsiCo, meanwhile, reported an operating margin of approximately 14%. The gap is structural. Coca-Cola is primarily a concentrate and syrup business that often refranchises its bottling operations. PepsiCo, however, operates a massive snacks division alongside its beverages, requiring more direct manufacturing and distribution infrastructure. While both are highly profitable, Coca-Cola's asset-light model yields higher operating margins, illustrating how different capital intensity dictates the final percentage. The net margin is the bottom line, calculated as net income divided by revenue. It represents the final slice of profit after every single cost, interest payment, tax obligation, and non-operating item has been accounted for. It answers the ultimate question. For every dollar of sales, how much actual profit goes to the shareholder? While this is the margin most commonly cited in headlines and stock screeners, it is also the most prone to distortion. One-time gains or accounting adjustments can swing this number wildly in a single quarter. For this reason, while net margin is critical for valuation ratios like price to earnings, many analysts prefer focusing on operating margin to assess the health of the core business. Visa provides a perfect example of what extreme net margins look like. With annual revenue of approximately $41 billion, Visa consistently delivers a net profit margin above 50%, reaching 50.2% in 2025 estimates. The economics are straightforward. Visa maintains a global payment network, but carries no credit risk, holds no inventory, and operates no physical stores. They collect a small fee on every transaction processed through their rails, which is essentially a toll road model with near-zero marginal cost per transaction. This net margin is roughly 3.8 times the S&P 500 average, showing how a highly efficient business design directly dictates bottom-line profitability. Margins cascade down the income statement like a waterfall. Using Microsoft's 2025 figures again, we see the gross margin at 68.8%, the operating margin at 45.6%, and the net margin at 36.1%. The drop from gross to operating, 23 percentage points, represents the $65 billion spent on research, marketing, and administration. The further drop to net margin, 9 percentage points, reflects $4.9 billion in interest and investments, plus $21.8 billion in taxes. Every gap tells a story about how much a company spends to stay competitive, how much it owes in debt, and where it sits in the global tax landscape. Apple has executed one of the most successful margin expansions in modern history. In fiscal year 2024, Their services segment, which includes the App Store and iCloud, reported a gross margin of roughly 73.9%, while their product segment stood at 37.2%. Services revenue grew from $24.3 billion in 2016 to $109.2 billion in 2025, moving from 12% to over 26% of total revenue. This shift lifted Apple's total gross margin from 41.8% in 2021 to 46.2% in 2024. This was a deliberate, decade-long transformation from hardware-centric to platform-centric economics. Conversely, Tesla illustrates margin compression in real time. In the second quarter of 2023, their automotive gross margin, excluding regulatory credits, dropped to 18.2%, down from roughly 25% just a year earlier. This was the result of aggressive price cuts across their entire vehicle lineup to defend market share against competitors like BYD, Ford, and Hyundai. By early 2024, gross margins had stabilized in the 17 to 18% range. While still profitable, this was a significant retreat from the mid-20s they enjoyed during their period of high scarcity. This serves as a lesson. When a company trades pricing power for volume, gross margin is the first signal to decline. Intel's fourth quarter of 2023 shows how competitive pressure can destroy margins from the top down. Revenue fell 28% year-over-year to $14 billion, and their gross margin collapsed 340 basis points to 39%. Their client computing and data center divisions both saw massive double-digit declines as they lost market share to AMD. With lower factory utilization, their fixed costs were spread across fewer units, which compressed margins further. Their operating margin eventually turned negative, and they guided for even lower revenue in the following quarter. For Intel, the margin waterfall quickly became a margin landslide, highlighting how quickly competitive erosion can impact the bottom line. Looking at the broader market, the blended net profit margin for the S&P 500 reached 13.1% in the third quarter of 2025. This is the highest level since FactSet began tracking the metric in 2009, surpassing the previous record from 2021. This marked the seventh consecutive quarter of margin expansion. The five-year average for the index is approximately 11.6%, and the long-term average from 1989 to 2015 was just 5.85%. Today's corporate profitability is essentially double the pre-2015 norm, driven largely by a structural shift toward technology and services, which account for over 75% of this improvement. S&P 500 sector margins in the third quarter of 2025 reveal extreme dispersion. Information technology led the way with a 27.7% net margin, followed by financials at 20.2% and utilities at 17.2%. At the bottom, energy sat at 8.2% and healthcare at 7.8%. The spread between the highest and lowest sectors is nearly 20 percentage points, a gap larger than the S&P 500's overall margin itself. Because of this, sector context is non-negotiable. You cannot evaluate a company's margins without understanding the norms of its specific industry, as 6 sectors are currently trending above their 5-year averages while others are lagging. Retail also demonstrates that low gross margins do not necessarily mean a bad business. They simply mean different mechanics. Costco's 2025 gross margin was approximately 12.8%, while Target's was 27.9% and Walmart's was 24.1%. Costco's low markup is a deliberate choice to drive membership fees, which generate the bulk of their profit. Target operates with a higher margin, catering to a wealthier customer base with private label goods, while Walmart uses its massive scale to squeeze suppliers. Their net margins are all relatively tight, roughly 2.6% for Costco and 3% for Walmart, but their gross margin levels are strategic choices rather than performance scores. Every investor should watch for 5 margin red flags. First, gross margin contraction over multiple quarters is a major warning, especially if competitors are stable, as it signals pricing pressure. Second, if operating margin falls faster than gross margin, overhead costs are likely growing out of control. Third, if net margin volatility is significantly higher than operating margin volatility, it suggests heavy debt, unpredictable taxes, or questionable accounting. Fourth, be wary if margin expansion is driven solely by cost-cutting rather than pricing power. as this is rarely sustainable. Finally, if a company has margins far above its peers without a clear competitive moat, it may be underinvesting in the business, which will eventually lead to a decline. To recap, use our three-margin framework to diagnose any company. Gross margin reveals business model quality and pricing power, like NVIDIA's 74.6% versus Walmart's 24.1%. Operating margin reveals execution and cost discipline, showing how effectively a company manages its overhead. Net margin reveals the final shareholder outcome, though it remains sensitive to one-time items. Always compare these figures within the same industry. Track their trends over several years, and always ask what the gap between the margins is telling you. A wide gap between gross and operating margins usually points to heavy research or marketing spend, while a gap between operating and net points to debt, taxes, or non-operating items. Margins tell you how profitable a company is on paper, but remember that profit is not the same as cash. A company can have beautiful margins and still run out of money if that profit is trapped in inventory or unpaid invoices. In the next episode, we will cover the most important financial document of all, the cash flow statement. We will explore free cash flow, capital expenditures, and the crucial difference between operating cash flow and net income. We will also examine where the money actually goes, whether it is being used for debt repayment, buybacks, dividends, or reinvestment, and why that matters more than any single percentage. I look forward to seeing you in episode 10.